Hello everyone. In today's video, we'll be discussing multiple time frame analysis and why it's a popular trading strategy that can help traders identify potential trading opportunities and gain a more complete picture of market trends. In this video, we will discuss what multiple time frame analysis is, why it's important, and how traders can effectively use it in their trading strategy. So within Optimus Flow, here we have a daily chart of the S&P 500, the mini S&P 500. And a simple way to implement multiple time frame analysis into your trading, specifically into Optimus Flow, is to pull up a chart, come to the three bars here in the upper left, and then duplicate panel. And then when you click and drag this, we can drop it into the same box, creating a group. And then we click on the second chart that we added, drop down to the time frame. I like to use a 4-hour. We're going to duplicate this again, drag and drop down here to the time, and we'll go 1 hour. Do it one more time to get a 15-minute for now. We'll add to these in a little bit. So now we have 4 different charts, all with different time frames. So now when we do our top-down chart analysis, we go to the daily, and we can pick a horizontal line here, set up some levels that we have seen price respond off of, maybe the recent high, and so on. So now we can click on this horizontal line, we'll right-click it, and then we want to go down here to availability, and I have it set to default on all charts with the same symbol. So when we go down here to the 4-hour, we see that these lines are already migrated over to the other time frames. 1 hour down, they're here. 15-minute, it's here as well. So with multiple time frame analysis, we're going to be analyzing price across multiple time frames to identify key levels of support and resistance and any trends. It's going to help us manage trades more effectively, and by using multiple time frames, we can gain a better understanding of market trends and make more informed trading decisions. So let's take a look at how we can put this into practice here. On the 4-hour chart, we can draw a trend channel here. Bring it up to the top of that channel. So now we have a clearly visible uptrend channel on the 4-hour chart. Now we're going to look at why multiple time frame analysis is important, specifically in this scenario. 1, it helps identify trends. So by analyzing price across multiple time frames, we can identify trends that might not be visible on a single time frame. This can help us identify potential trading opportunities and make more informed trading decisions. So when we drop down here to a lower time frame, let's say 15-minute, there is a short-term downtrend here. So within this longer-term uptrend on the 4-hour, price has been working down to the bottom part of this 4-hour channel. So with that said, if we were just looking at the 15-minute, and actually what we're going to do for this is we're going to go here to the 4-hour, right-click on this 4-hour channel and apply it to the current chart. So now when we go to the 15-minute, we will not see it. So if we were just trading on the 15, it's clear that price is in a downtrend. And these might be potential shorts that you would be tempted to take because it's been trading in this downward channel. However, when we look at the longer time frame, the 4-hour, we can see that a short position may not be the best probable trade if we think this longer term uptrend is going to hold. So a better entry might be when these two time frames converge. If price were to come back down again to this 4-hour channel, that might be a potential long. Another reason why multiple time frame analysis is important is because it can help us avoid false breakouts. So let's say that overall we thought that the 4-hour trend was going to hold and continue upwards, and we're trading off the 15-minute chart. If price comes down to this 4-hour channel and we enter a long position, essentially price could come down to the bottom part of this 15-minute channel and then turn back into the 4-hour channel. So this would also be a good indication of where we might want to place a stop if we thought price might trade below this 4-hour channel, but not below the bottom of this 15-minute downtrend. Taking a look at how we can use multiple time frame analysis and how we can use it to provide better risk management, we can use a tool here in Optimus Flow. Come over here to Drawings Library. Scroll down to Price Targets. Now we said that if our hypothesis was that the 4-hour channel was going to continue, we could enter here when it hits. Draw it out a little bit, and we said that a potential stop might be below this 15-minute downtrend channel. Our target, let's say, could be the top of the 4-hour channel. And these are all hypothetical, but just an expression or an example of how to use these tools to provide better risk management. So in this situation, our reward to risk is 4.32. Our stop would be here at 41.11, and our take profit would be here at 42.68. In this scenario, we've used two time frames to determine the overall trend, the intermediate short-term trend, and identified a potential trade by utilizing these two time frames and properly putting our stop and our take profit in the areas that we think price may go. I hope you enjoyed today's video on multiple time frame analysis. Optimus Flow is a free platform for Optimus customers. If you'd like more information, go to optimusfutures.com.